We're on oil this morning, and if you skinny this 89 tick chart down, let's go over here and look at this. You're going to see some multiple levels on it, and the multiple levels are this. The 89 tick chart will have these red dots. The green dots are below right here, and then you'll see these big blue hash lines and big red hash lines. These big blue and red hash lines are previous weekly, monthly, quarterly, and yearly support and resistance levels. They're old highs and old lows. They become very big levels, okay? The red levels are the previous high day, and then the green levels are previous low day. As you can tell, my previous quarterly, yearly numbers and weekly and monthly numbers are very good support and resistance levels we play off of. But the previous high, previous low day, let's look how we trade off those. We had a good failure yesterday. Let's take a look how we trade off here this morning. If you are above the previce high, now the previous high will be categorized as the red dots. The previous low of the day will be categorized as green dots. Okay, they'll look just like this in the 89 tick chart. They are on no other chart. Okay, only on the 89 tick chart. If we are above the red dots, it's an outside day. If we are below the red dots and above the green dots, we are on an inside day. In other words, if you're above the previous high day, it equals an outside day. If you're below the red dots and above the green dots, you're on an inside day. If you're below the green dots, you're on an outside day again. In other words, above the previous high day is an outside day. Below the previous low day is an outside day. So if you're above the previous high day, it's very bullish. Below the previous low day, it's very bearish. If you get back inside of the outside day, it comes back down to an inside day. That becomes very bearish if you've been on the outside. So I call this a failure trade. If we've been outside of the previous high day and we come back inside of the previous high day, there's a very simple setup where you'll see hundreds and hundreds and hundreds of trades like this. This is called a bearish retest short. It's a very simple one that we've done all year in 2012. We'll do it all year in 2013. It's one of the easiest trades to take in the room because your stop is not a full 13 to 15 tick stop. Your stop averages around 4 to 6 ticks on this trade. What we do is if it is in an outside day, very bullish, and we finally go back to bearish, breaking back inside of the previous high day, we look for the first retest short. Now, we had a trade like this yesterday on a failure too that worked perfect. It was a huge trade that M took yesterday. So what you want to do is you want to look for a breakdown, retest. Now, here's the key to this trade. You do not short right there. You cannot short right here, because the wicks do not count. I need the body of the candle to get into the previous high day. Now, this is very, very key. You have to let the body of the candle get into the previous high day on the retest. So when we come down, we retest the previous high day. The body of the candle is right here. It gets into the previous high day. What we do then is we look for the first red bar reversal on all retracement trades. Yeah, we go over that every single week. It's a hard rule in the room, Bruce. Go over that every single week. Muscle memory, my man. You have to let the body of the candle get right in there. Okay? So the body of the candle's got to touch in the previous high day. Okay? So the body gets in there, right? Once the body gets in, we have to make sure that we look for a red bar reversal, okay? Okay, good, Bruce, good. Yeah, you had a nice day yesterday, Bruce, on Live Money. Good job on Live Money yesterday, buddy. Nice job, man. So the body of the candle's got to get into the 89 tick. The body of the candle's got to get into the previous high day, okay? Then we look for the red bar reversal. Now, when we're coming up to the previous high day, start looking for your oscillator below. You can use it as a confirmation. You want to see lower highs because that means there's more supply on the retest. Lower high, higher high in price. That means there is what? There is divergence. So that trade is a really easy trade. It's one of the easiest trades that you can teach anybody that can pick up in one day. I mean, it's that easy. You break down the previous high day. You retest the previous high day. You look for the red reversal bar. You look for more supply or divergence. It doesn't get any easier than that. It's a very simple setup. So your stop is going to be this, though. Here's the cool thing about the stop. The stop is not a 15 to 13. A lot of you use a 13 to 15 tick stop on gold and oil. Your stop is not a 13 to 15 tick stop. So you don't have to have your stop all the way up here, right? You don't have to have it up here. And when you have a red bar reversal, you're looking for an immediate reversal on the previous high day retest short. If that candle closes after red bar reversal, a full body candle close without the wicks don't count me. It can go up the wicks can go up and go right back down and body candle close below it. But if you get a full body candle close above the previous high day, that is a exit. Usually 4 to 6 tick stop out. In other words, you can get these trades. This trade, my first target's hit, is a natural target is the symmetry dots here. The second target is my natural symmetry dots front running by 2 ticks. So you're looking at a trade right there. That was a 40 tick trade already on oil this morning. And it was one of the easiest trades that you're going to ever find in the market. It's so simple because you only have around a 4 to 6 tick stop. It doesn't get better than that, okay? So let's make sure that you understand that. There you go, Paul. When you break down, if you're an outside day above the previous high day, and you break below the previous high, it becomes very bearish. Because you've been bullish. You've been outside the previous high. That's a bullish mode. According to the institutional traders, that's bullish. You get back below, that's bearish. It's called an outside to an inside day. You come back down, you retest it, where a lot of traders don't understand. The wicks don't count. You want the full body of the candle to get into the previous high day. You want the first red bar reversal. There's your spinning top, your doji, I mean. We'd love to see dojis. Indecision candle on a retest. And there's a red bar reversal with major supply, lower highs. Okay? Your stop out's going to be very simple. Your stop out is going to be a whole body candle close, not the wicks. Body is this big green and these red bodies. And then your first target is going to be the first set of symmetry or your automated dome. Your second target is going to be the second set of symmetry within 2 ticks. It's that easy. Nothing else to do. Are we all clear on the previous high, previous low day? We always go over market profile. We had some huge trades yesterday on market profile. I want to make sure we understand this first. Everybody clear with the body of the candle getting into it? Anybody not understand that trade? Happens all the time in the room. One of the easiest trade setups because the stop's so small. No. Don't short the breakdown, Robert. Don't short the initial breakdown. Look for the retest. Now, if you got symmetry dots lined up right at it, right below it, see the symmetry dots are right above it here, Robert? It's a great question. See the symmetry dots? Then a close below, a 2/3 candle close, you can take a shot at it then, right? But I would make sure that the trend was hard down. The trend was a hard down this morning. The magenta MA is flat. In other words, if the magenta's hard down, Robert, we're only looking to short the previous low day. Remember, if the trend is hard down on the 5-minute chart, then here's our pattern we look for. We look for a breakdown, right? We don't look to buy the previous high day if we're down. Then we look for a retest, and then we look for a short, right? That's our pattern we look for, right? If we're in a hard downtrend. If we're in a hard downtrend also, you can short the 2/3 candle close below if the symmetry dots line at or below the level right there, right? But then make sure you're in a hard downtrend. Does that make sense? All data providers will be the same, Michael. This is Zenfire you're seeing right here. You're looking at Zenfire. They'll be a little bit different off, but not much. Okay? But that's our pattern we look for in the previous high, previous low day. Remember on the previous, now look, if you're looking for if the market's in an uptrend, then this pattern is going to be this, right? You look for it to come down, and we look for a retest long. It's a very simple setup, right? If we're in a major uptrend, then we look for it to break through the previous high day. We don't look to short it. We look for it to break through, retest, go long. We look for a long setup, a green reversal bar right here.